Okay, here we are in week two. We're going to look a little more financial analysis this week. Do a bit more on our financial statements and start moving into things like ratios. Okay, so when we do financial analysis, we're going to be doing things like vertical analysis, which means we take ratios and other something called common size statements, and we compare each one of our uh, accounts, i.e., whether it's rent or asset or land and buildings, whatever the case may be, and we compare them to things like sales or assets. That gives us a vertical, what's called a vertical analysis, and basically we're comparing numbers within a financial statement. So comparing numbers within the income statement, comparing numbers within the balance sheet, that sort of thing. Horizontal analysis means we compare things over time. Okay, so we compare things from one year to the next. Or using both vertical and horizontal analysis, we take our numbers and compare them to outside companies or benchmarks. Okay, depending on what the situation may be. Financial analysis also looks at the sources and uses of our money. Ratio analysis. We eventually get into break-even analysis. And there's something called leverage analysis. We may get into that in this course, but I kind of doubt it. And I say that because sometimes we get a little pressed for time, and it's not typically what we are terribly concerned about in small business. And a little bit about risk analysis, and that part of the course is kind of intuitive anyway. Okay, so that's your introduction. Away we go. Financial analysis. The big reason we do that, and I'll be hammering this day after day after day, is so that we can make decisions, better decisions. Decisions about how to finance the company, working capital decisions, as in how much cash or liquid funds should we have on hand to run the company. Budgeting, how much to spend, when to spend it in terms of long term. Capital budgeting talks about long term. Should we buy that truck? Should we buy the building? When should we buy the building? How much should we spend, or are we able to spend? Growth decisions. Everybody says growth is good, but sometimes way too much or way too fast growth is a bad thing. And of course, negative growth, that's a bad idea usually, unless you're going to downsize and hopefully make better profits. Hiring decisions. Yeah, hiring decisions. If we're projecting growth, sometimes we have to hire some more people, or conversely, if we're projecting a decrease in growth, we have to contemplate some layoffs. Capital structure, so how much to borrow versus how much to invest to get some shareholders. Lease or buy, whether we should buy our capital equipment or lease it. Pricing, how much to charge for our goodies. Operating budget, inventory purchases, that sort of thing. So capital budget is our big assets. Our operating budget is our little assets. So we're usually dealing with current assets and current liabilities. And down the road, if we want to sell the company, valuation, how much we're going to sell the company for. And typically this isn't something we do right away. We're not going to talk too much about that in the course. It's also something we usually leave to professionals or somebody with a really good working knowledge of the business. Okay, ratios. We cover quite a few ratios in this course. Current ratio and quick ratio, you should already know. And actually, you should know the gross margin and the net margin as well, something you've taken previous courses. These four you should memorize not just for the rest of the course, but if you're going to be in business, you should memorize for the rest of your life, just the way it is. Again, if you're approaching somebody, want to make an investment, want them to help you make an investment decision, then you really should know these ratios and when they come up, what they mean. As an aside, if we want to make our current ratio look better, then of course we have to have more current assets or fewer current liabilities. All right, the next ones you should know are gross margin. That's net sales or net revenue minus cost of sales divided by the net sales. It'll give you a percentage. And industry standards have evolved over the years in such a way that many businesses or industries have a set or advisable ratio. It's particular to whatever industry you may be in. Some are as high as 95%, for instance, but a lot of others, I think, let me think, retail, clothing, if we look at clothing, is typically gross margin usually around 65, 70%. Um, Retail in terms of variety store, we usually look around 50% margin. And some others like donut shop, for instance, around 50, 55% gross margin. Okay, again, this is an indicator of your profitability on the goods you actually sell day to day. Okay, profit on the goods you sell or the services you give day to day. Okay, so if you're looking for a 50% gross margin, then I'll use the candy bar example again and say, okay, well, if I'm going to sell my candy bar for $1, then my gross margin should be 50%, which means I should be paying 50 cents for that candy bar. Okay. Net profit margin, again, turns out to be a percentage. It's your net profit, so your bottom line divided by your top line gives you your net profit margin. These are in percentages. Okay, so when we talk about margins, we're talking about percentages. And typically, in small business, we can usually, if I'm looking at something in a small business just off the top of my head, I assume their net margin's around 10%. So at the end of the year, their profit divided by their sales is around 10%. For both margins, the higher the better. Okay, the higher the better. Let me see. I'm just trying to think if there's anything else that we should be looking at. No, actually, so that's it for this group of slides. We talked last week about income statements, so I'm back to income statements again. Income statements show profitability for a year, usually for a time period, usually a year. We can do it monthly, which is what many business owners do. Some even do it daily, but that's not such a great indicator of profitability. Okay, so basically we talk about revenues from customers for services or merchandise, minus expenses from vendors and other overhead. Okay, we typically do it in steps, and we spit out a profit at the bottom. Quick review. The steps would be sales minus cost of sales equals gross profit, minus operating expense gives us operating profit or EBIT, minus interest expense gives us earnings before taxes, and then we wind up right at the bottom there getting our net profit. Okay, earnings after taxes. Each one of these steps has a different focus. The gross profit gives us an indicator of our profits on the goodies we sell. Step 2 gives us a sort of a more of a period profit. So once we've got our gross profit on the goodies we sell, can we pay the rent in a month, in a week, in a year? Okay. Next, we look at interest expense, and interest expense is taken out because it's a financing decision. How I run the company or sell things day to day is not really dependent on my interest expense. Okay, it's not direct. The more sales I have, it doesn't matter. It's not rent in the sense of I need to rent out a place. Okay, it's interest. I'm renting the money, and the interest expense can change depending on how much money I invest in my company, because I typically do not pay myself interest if I'm buying shares in the company. So that's a bit of a different type of expense. Still overhead, but it's a special type of overhead in that it has nothing to do with the day-to-day functioning of the company. It's a financing decision. And taxes, of course, have nothing to do with how we run the company or finance the company. That is, you could almost say, is a government decision how much they charge us on that. So as I explained in the last slide, we have to think about what each step accomplishes in the income statement. Remember why interest is separate. And every once in a while we might see something where we own a building and rent it out. Okay, or we rent out a big warehouse, but we've got too much space, but we think we're going to expand. So we might rent out a small part of the building. So we might have rental income in that. And I mentioned interest income in the last week. So those are two special sections of income. And that would go down by the interest, actually, interest expense. Okay. Because really, the day to day operation of the company doesn't really depend on our rental income or our interest income. Okay. So the performance, the profits, we're trying to separate out profitability in terms of cost of goods sold and the overhead. So things like interest, rent, interest and rental income, if we're in the rental business, that's something else. But if it's just these two things, rent and interest, and they turn out to be income, we typically don't want to count them in the calculations of revenue and profits because they tend to give a false picture if we do. So we split them out. And that's it for this deck of slides.